Well, hello, everyone. Cynthia Tomain once again with Interactive Brokers, and thank you for joining today's webinar that's being brought to us by Mott Capital Management. We're very pleased to have Michael Kramer with us today to discuss how stocks may be setting up for a rally. Now, Michael is the founder of Mott Capital Management. He's also a financial writer for websites such as Investopedia, Seeking Alpha, and the Monster Stock Market Commentary, providing stock and market analysis. Michael has over 20 years of industry experience as an analyst, trader, and investment manager. He's earned his MS in Investment Management from Pace University and a certificate in Risk Management from New York University. Michael's unique investment philosophy centers on seeking investment opportunities that are influenced by everyday life activities and by observing new trends and products that are popular or are trending towards popularity. Additionally, Michael Kramer runs Mott Capital Management, an actively managed long-only thematic growth portfolio. So with that, please join me in welcoming Michael. Now, I'm going to go ahead and pass you the controls, Michael, so if you can share your desktop, let's get underway here this afternoon. Thanks for joining us.
Hi, Cynthia. Thanks for having me. I appreciate everyone taking the time to join me on this rainy New York day if you're in New York. So today we're just going to run through some thoughts I've been having about the equity market. For those of you that may have joined us the last time, you can think of this as kind of an update to where we were in July. And for those of you that are new, this will kind of give you a sense of what I'm thinking about longer term for the equity market over the course of the next year. So this is just a brief disclosure everyone can just take a look at. And so one of the interesting things that have taken place now, more recently, is that if we look at treasury yields have fallen sharply. And if you remember back in July, we were talking about why it was I thought yields were going to be falling. And at the time, they've fallen dramatically during the period of the end of July through the middle of August. And basically what's transpired is that Treasury yields today, especially on the 10-year bond, have fallen to a point where they're now cheaper than the dividend yield of the S&P 500. So being that the S&P 500 has a dividend yield of call it about 1.85%, the Treasury yield currently at about 1.55%, give or take. And so basically what that created is this inversion or a spread of negative 30 basis points. So basically an investor can go today and go and buy the S&P 500 and get a higher yield or a higher return just from the dividend yield than they could for the 10-year Treasury. And when you think about what that means, it actually would suggest that an investor today can buy the S&P 500 and get a better return right away, and also have all the growth that comes with the earnings of the S&P 500. So in a lot of ways, in my mind, this is what makes equities very cheap compared to bonds, because you can basically buy the S&P 500, get a better dividend yield, and all the growth that comes with the S&P 500 over the next 10 years. Or in a Treasury bond, all you're going to get is 1.55% for the next 10 years. This phenomenon has actually only happened 4 times since 1994. And one time, the first time it happened was in 2009, of course, during the crazy times that were the financial crisis. And then it happened again in around late 2011 through the beginning of 2013. Of course, this was also a very volatile period of time when, if you remember, we had the S&P downgrade of the U.S. debt. We had the Eurozone debt crisis taking place. If you remember, there was a lot of concern about Greece potentially defaulting on loans. And that's when the ECB stepped in and started to do things like bank bail-ins, where basically you had countries like Cyprus and Greece and some of these little European countries were basically, if the banks were insolvent, instead of them eventually being bailed out, the depositors were actually covering and making up the cost of the shortfall of the bank. And then, of course, it happened again, and then we had the same phenomenon happen again in 2015, 2016, where Treasury yields were once again trading at valuations lower than that of the S&P 500 dividend yield. And again, during that time, 2015, 2016, if we remember what was taking place, there was a global growth scare, there was an earnings recession, there was the institution of negative interest rate policy in Europe and in Japan, where we saw the central banks in those countries actually, have people have to pay the government to buy the bonds of the country because they put rates so low, and they also instituted quantitative easing policies to help push down rates on bonds in those countries. And of course, we also had Brexit during that time, another market uncertainty. And then, of course, today we have concerns about global growth slowing again. We have concerns about the trade war here in the U.S. and China and how that's going to potentially impact, the global economy, U.S. manufacturing, and things of that nature. And when you look at these three periods of time, discounting 2009, when you look at the periods of time in 2011, 2015, and today, what you'll also find is that the equity market went through a period of about 18 to 20 months of consolidation, meaning that the equity market really didn't rise for nearly a 2-year period of time in 2011, 2012, 2015, 2016. And basically today we're at the same point that we were in at the end of January 2018. And it's interesting because the periods from both the S&P 500 dividend yield standpoint and from an actual market valuation, that price level, the similarities are very similar. Although the scenarios are slightly different, we have similar type of concerns today. And then, of course, when we look, there's another characteristic that I find very interesting that's taking place when you look at it more from like a technical standpoint. So what I found was that from the period of 2011, which is where my pointer is, hopefully you can see it, to basically about 5 months prior, the S&P 500 in 2011 through 2012 basically went nowhere, and you can see how there's a level of resistance at around 1390 going back to 2011, and there was a 23% drawdown at the midpoint. And then finally, around late 2012, you had the S&P 500 rise above that level of resistance and eventually begin to break out and move higher. It took about 5 months thereafter, the initial breakout for the S&P 500 to begin to rise. In 2015, you see a similar scenario occur where, again, it was about 20 months of sideways consolidation. We had a 15% drawdown at the middle. Again, with about 5 months prior to the initial move up in the equity market, you see there was a breakout above resistance, 4 months of retest, and then finally the move higher. And of course, here today, you can see we've been at resistance now for about 20 months. Again, you can see we had a 20% drawdown, 4 months currently of testing support at 2880. And of course, now potentially on the 5th month would be the next month where in November, so to speak, is the month I'm beginning to think about that we would begin to see the equity market move higher. And that's why I'm starting to think about, higher price levels for the S&P 500 from where we are currently. When we go on to the next slide, a lot of people have been worried about the fears of recession. And I think what gets lost in a lot of things that really no one focuses on, right? Because people today, a lot of times in my experience, they just don't have the background, the history, the time in the marketplace that's sometimes required to remember periods in the past. One of the advantages I found over my time is that I started all the way back here in 1994, investing 95, really starting to follow the stock market at 16. So I have a really long memory in terms of events that have taken place. And what I found interesting was that the S&P 500, despite the the fluctuations that have taken place because of the fears of the recession, people have pointed to the 10-year minus 2-year curve quite a bit. And what they don't realize is that when the yield curve has inverted, it's inverted for a very long period of time. When they say it takes 2 years from the inversion, beginning of the inversion until the recession, it's because literally the inversion lasts for almost 2 years. And at this point in time, to say that a recession is coming is almost premature, because we have barely inverted for a very short period of time. In fact, the spread is now positive. The yield curve inverted for a very short period of time in July and August, and then basically uninverted. But if you look back to periods in 2007 and 2006, you can see the yield curve was inverted for a very long period of time, nearly 600 days, and it was inverted by as much as negative 18 basis points. If you go back to the late 90s, in 2000, it was inverted for almost 400 days at a steepness of almost 92 basis points. And if you go back until the year 1989, again, it was inverted for nearly 600 days at negative 50 basis points. So today's inversion actually resembles something more like what we saw in the around 1998, even maybe 1995, where you got really close to an inversion. Maybe you even inverted just a little bit, but it didn't prove to actually be a recession trigger because the inversion was shallow and it was very short dated. So again, that's one reason why I really do believe that a recession at this point, although one can happen at some point in the future, I don't think it's imminent. And if one is coming, perhaps it happens beyond 2021. And when we go on to the next slide, another piece of evidence that would suggest that recession likely isn't coming anytime soon is that the ISM manufacturing PMI has been a point of focus for recession warnings. And although the latest reading came down to around 47 at the time I did the chart, the data only went through the 49.1 reference. You can see that really recessions only occurred when the reading got below 45, maybe 44. And even at that point, there are points in time where we had readings below that. 1967 or so, you had a reading below 45. There was no recession. Even in the early 1950s, you had even steeper readings that didn't necessarily lead to recession. So although the PMI has historically been a decent indicator, it is not like 100% given that because the PMI is below 50 and contracting means that we're going to be heading to a recession. The PMI would need to fall considerably further from even where it is, perhaps below 44, before we could even begin to think about the idea that, hey, look, we really are heading towards recession. And if you look at the latest, if you actually read the ISM report, what you find is that the PMI number corresponds to like a 1.4 or 1.5% GDP growth rate, which isn't great, but it's certainly not recessionary. And so from a lot of standpoints, I think a lot of these recession fears have been a little bit overblown. When we go into EPS trends, this data is from Dow Jones, S&P Dow Jones, and it's great because you can just type in the S&P Dow Jones earnings into Google, and you can get this data for free. It's a great thing that they provide. And we can see the general trend for earnings has been lower since peaking in late 2018. But the good news here is that there's still considerable room for earnings to grow in the future. You can see estimates are calling for about $180 in earnings next year, over $160 in earnings this year, which is about 10%, 11% growth, which is a solid return, considering that this year earnings growth is expected to be fairly small. And although it's trending lower, like I said, it's not trending lower at a pace fast enough to really have any harm, I believe, on the PE multiples of the equity market. And then I developed my own model as well. And basically what I do is I take the EPS estimates on every single company in the S&P 500 and I aggregate it. And then I have my formula and model to come up with my own estimates. And I've been tracking them, and you can see basically since the beginning of June rather, earnings estimates have fallen from about $183 a share to about $180 a share. So certainly, I mean, it's down $3, but it's not significant in my mind. And then when you think about the extremes, right? In my model, one standard deviation for the S&P 500 in earnings for 2020 gets us somewhere to about $170 per share. And I'll show you why I think that's significant a little bit later. Again, when we look at the earnings trends, when we model out to 2021, we're looking right now, I'm modeling out for about $198 a share in earnings, and that would be pretty decent growth from the $180 a share I'm modeling in 2021. So that would be about 10% growth from 2020 to 2021. And when we think about where we are currently in the cycle, currently the S&P 500 is trading at around 16.5 times one-year forward earnings. Now that's a little bit more than where we were trading in 2018 and 15, but you can see from the other slide, it's well below where we were in 2017, and even further below the average since 1988. I calculated using the data from S&P Dow Jones that since 1988, the S&P 500 has traded typically at 17.5 one-times forward earnings. So trading right now around 16.5 seems like a rather low multiple to me, and would suggest that there's still actually room for multiple expansion in the equity market, which could be further bolstered by the fact that we have such a low interest rate environment. And again, here's another slide that shows based on 2021 earnings, because remember, it's October, so for all intensive purposes, the year 2019 is basically coming to an end. And for the market purposes, investors will start thinking about the equity market 6 to 9 months ahead. And when that's the case, we start looking out. Now all of a sudden you're looking out to the middle of 2020, and we could start thinking about 2021. We're trading at less than 15 times 2021 earnings estimates, which is actually would be a fairly cheap valuation. And then when we think about where we are currently, remember I showed you the slide with the standard deviations, and why I think that's important is because currently in a worst case scenario at $170 for 2020, we're trading at 17.5 times earnings. So what that tells me is that if earnings on the S&P 500 were to fall another $10, or from 180 to 170, the S&P 500 would be fully valued now. So you would still need to see a lot of earnings, earnings estimates really fall substantially from here to really see the worst case scenario play out, where there's really no more further room for the equity market to rise. And even on a 2021 earnings multiple, we're only trading at 16 times a worst case scenario of $184. So there's a lot of room for the equity. I mean, that would be almost a $15 decline, which on $200, you're talking about about a 7 to 8% move lower in earnings still for next year, which would be pretty substantial. So at this point, I'm thinking that perhaps the equity market in a worst case scenario is fully valued, and in a mid-range scenario, it's probably slightly undervalued. And in a best case scenario, assuming everything gets better and the trade war with China is resolved and there's no problems in the world, we're probably significantly undervalued, because there'd be a lot of room potentially for earnings to rise in the low interest rate environment, assuming an economic recovery. And so what I do now is we can start thinking about by tacking on the current PE ratio of 16.44. We get a 10% earnings growth rate from 2019 to 2020 at a 17 multiple. Gets us to 33.57 is my target, which is about, well, now it's a little bit more, because when I did this slide, the market was a little bit higher. About a 15% increase in valuations from where we are currently. And this 33.57 target for 2020 is off of using a 17 multiple off the $197.50 in earnings. And so the fact that I think that 17 I'm thinking is a fairly conservative number, number one, because it's still below the historical average. Number two, we also have a very low interest rate environment, and the low interest rate should help to spur market multiple expansion. Because remember, back to the very beginning of the slide, would you rather own a 10-year Treasury at 1.55%, or would you rather own the S&P 500 and get that dividend yield at 1.85% plus all the growth that comes with it? I would prefer the S&P 500 over those two options any day. And I have reasons to believe that the market is going to continue, at least inflation rates are going to continue to stay low, and that's going to keep interest rates low. Because when you look at the velocity of money, for example, the velocity of MZM, you can see that that has been falling substantially over time. And what's most glaring to me is that in 1980, so we think about the velocity of MZM in the simplest terms, it's merely a ratio, right? Which is nominal GDP divided by the MZM money stock. And what we can think about it as, for every dollar created in money in 1980 created about $3.50 worth of GDP. And then and today, for example, every dollar created in MZM creates only $1.30 in GDP. So that's one reason why inflation rates have been so low. Essentially, there's not enough growth in the economy. We're not generating enough return on every dollar created in order to really spark inflation. And people will say, well, how do you correlate the velocity of MZM to money? And I do that because when you overlay the 10-year Treasury rate with the velocity of MZM, it's a nearly perfect correlation going back to the 1960s. And so if yields are a derivative, or if yields are derived from what expected and future inflation rates are, and we can think about then that the velocity of money is actually an indicator of what future inflation will be. And at this point, there's no sign of the future of inflation turning higher at any point, especially if we're going into an economic slowdown, as many people believe, and GDP growth has slowed. You actually might see the velocity of MZM actually decline in the future still, because the government, Fed, is still printing money at the same pace, basically. Actually, more recently, I've noticed the pace has picked up, and GDP growth is slowing, so that will only push the velocity of MZM lower, which will likely keep yields low for some time to come. So I'm going to open up the call at this point to questions if anybody has any. I'd be more than happy to go through what we just went through, answer any questions on top of it, or just let me know. Do we want to give it a second, I guess, to let people see if they have anything?
Well, Michael, while we are waiting for questions, and I would like to remind everyone there's a questions panel over on the right-hand side of your screen. Simply double-click that title bar, and you can address any questions that you might have for Michael at this point. But what I'm going to do right now is actually grab the controls back for a moment, because I do want to show everyone where they'll be able to access information on Interactive Advisors. Now notice I've brought up our web page, and I do want to take you to the products menu where you can find Interactive Advisors. Here is where you can find some additional information on the program that we do have available. Notice here you'll see there are portfolios that are available, and you can choose from any of these portfolios, but do want to take a moment and show you that thematic growth is one of the portfolios available through the Interactive Advisors platform. Here you can learn more about it, performance, holdings, and transactions. So if you do want to look a little bit further into this thematic growth portfolio, please do take a look at the Interactive Broker website. Okay, well, with that, I see a question has come in. Michael, if you want to address that question, I'll go ahead and pass you back the controls for just a moment. If you would simply show your screen, we can get back to your answers.
Sure. My slide just
Ah,
went down.
the slide just went down. Well, you know what I'll do is I can show those slides.
That's
So
okay.
let me grab
I
the
got
controls
it.
over. Oh, you do? Okay, excellent.
Yeah. Okay. So the first question is asking me, basically they're asking me, what do I think about the trade war, and also any thoughts on gold. So yes, first of all, when I think about the trade war, is that I think the trade war, by and large, I think is an overblown situation. Although I can't deny that it has a material impact on the equity market, I think the impact it's having on the overall economy is overstated. If we go back to just the very beginning of the trade war, people were estimating if all $550 billion worth of goods were actually impacted, and they all received tariffs that were imported from China, the estimates were at the time it would only have a 0.3% impact on future growth, which on GDP, which is actually a really minimal amount of money when you think about an economy that generates about $20 trillion a year in GDP. So it's not even a 0.3% impact on GDP. It's a 0.3% impact on the growth. So, for example, if we were going to grow at 1%, 1% of 20 trillion is $200 billion. 0.3% of that is like $60 billion. So it becomes to me, it seems like a very insignificant amount of money. It's not to say that it doesn't impact supply chains and certain companies. I think the trade war itself can have an impact on certain companies, but I think largely overall how it's impacting the broader economy is overstated. Although I do think, based on what I've been seeing and reading, because I read a lot of the Asian newspapers, it seems the stance of China has softened a little bit towards the trade war, especially given that if you follow some of the newspapers like the Daily Times, I believe it's called, or the Global Standard, there's been a little bit of softening from their stance where they were probably in May. And so I think the Chinese, I think, are more anxious to make a deal, and I think the U.S. is more anxious to make a deal, or at least come to some sort of resolution in terms of where we are currently. I think that it has had a great impact on China, and I do believe that if you look at their GDP growth, that they can't really afford to see their GDP growth slow much more. And basically my belief is that once supply chains move out of China, they aren't likely to come back anytime soon. So I do think that the trade war has a psychological impact on the equity market, and I do believe that both sides want to reach some sort of temporary truce, and I think we're actually going to see some positive commentary out of this meeting. In terms of gold, I don't really think about gold as an investment. I think gold is nice to wear as jewelry. I think gold is great to to have as if you want to have it in the form of coins for collectibles. But I think gold in itself isn't worth really thinking about, other than perhaps maybe investing in the actual gold miners. But gold, physical gold, to me is an asset that basically has a store of value, which has a carry cost, and gold itself, isn't attractive to me. I mean, other metals are when they have industrial uses like copper, palladium, platinum, silver. Gold doesn't even really have that industrial use. So for that reason, I really don't think about it. Let's see. The next question is: the previous time that the S&P 500 broke out of its consolidation phase was clear a catalyst, the expansionary fiscal policy of the Trump administration. Do you think a catalyst of some sort is needed for the S&P 500 to break out of its current consolidation phase? What do you think that catalyst could be? Thank you. So could there be a catalyst? Yes, I think that each time there was a catalyst, clearly there was an improvement in growth. There was an improvement. The most recent one in 2016, of course, was the Trump election, which got people excited because Trump had the Republican House and Republican Senate. They were able to get tax reform done. It was clear that people believed that Trump's policy towards business would be positive for the economy, and that it would spark a reflation trade. Yes, I do believe that there will be some catalyst that will be needed, potentially to put the market on a path higher. That being said, I think at this point, the catalyst may come in the form of either one, a trade deal, or two, which is something that people really don't think about, is that people will begin to realize after the next earnings season or two that that basically, the trade war itself hasn't really had the impact that people were expecting. And if that's the case, then I think you'll probably see the equity market rise just because expectations have become so gloom and doom, I guess. And if people begin to catch on to the fact that, hey, look, the trade war has affected some businesses, and those businesses have now kind of migrated around the issue, then why have we been so bearish on equities? The other thing to think about too is that we also have a period in time, for the first time that I can remember, where every single central bank around the world is actually in an easing stance. 2015, 2016, we didn't have that. Remember, the Fed was actually trying to raise rates in 2015 and 2016, while the ECB and the BOJ were in an easing process. So you actually had these cross currents taking place. This is the first time you've ever had, that I can remember in recent history, going perhaps back until 2008, where you actually had all the central banks acting in harmony, meaning they're all easing policy. And if that's the case, then perhaps the market can begin to think about, hey, this may be a trough in the economic slowdown around the globe, and perhaps we will be entering a period or a rebound period in the months 6 to 9 months ahead. Remember, it usually takes about 6 to 9 months before monetary policy to impact or be felt in the economies. So the Fed only first started cutting rates in July. We may not really start seeing these impacts of these rate cuts between the Fed and the ECB, and then even some of the other smaller central banks around the world until perhaps December or January. So there are a number of catalysts that are potentially out there, and it doesn't have to necessarily be that there's a resolution to the trade war. Actually, I just looked at the numbers last night, and the amount we're importing from China has fallen dramatically since October of last year. I think it was maybe December of last year. I'm sorry, we were around 50 billion, and now we're down to around 40. I'd have to double check the numbers, but basically the amount that we're importing from China is declining, and so that also becomes a more irrelevant number as those numbers begin to fall. And then the next question it looks like we got here is gold has given a return of 30% last year. You don't like it? No, I don't like it. Gold has really, if you look at what gold has done over the last 5 years, it's basically done relatively nothing. And except for that one period in maybe 2010 through 2013 and 14, gold was basically a horrible investment for a really long time period. I think since probably the 1980s, when I was maybe like a 5 or 6 year old kid, I remember my dad buying gold coins because that was like what everyone was doing then. But then the gold basically did nothing for the next 2 decades. And except for that one period, if you look at the returns of the S&P 500 versus gold, hands down the S&P 500 wins easily over gold over the last 20 or 30 years. So I don't like gold. It may have a run here and there, but I don't think you can compete against what the S&P 500's done over the last few decades. So I don't see any other questions at this point. I hope I answered everyone satisfactorily. If anyone has any follow-up questions, we can give them 30 seconds or so to try to, otherwise we'll just call it a day.
Well, with that, I would like to remind everyone that we have been recording today's session, and each of you will get a direct link to the follow-up soon after today's event ends. So if you do want to come back and review the concepts that Michael discussed today, simply watch your inbox later on this afternoon for those direct links. By the way, Michael had mentioned a previous webinar, which is actually more of a part one to today's sequel here. You can find that webinar on the Interactive Brokers website. Underneath the education menu, you'll find a webinar section, and simply going in and filtering by presenter, you'll find Michael's previous presentation is also available. So with that, Andres does have a question, and he's just typing, so I will hold off for just a moment so that we can get that question in.
Sure.
I'm not seeing that information come in, Andres. If you do have a question, I'm going to be sending out a follow-up with a direct link if you do have any feedback. Oh, there it is. Okay, excellent.
Looks like we got two questions.
Okay.
The first one's from Joseph. The effect of historically low interest rates increasing security valuations is well accepted. What, if any, secondary effects do you foresee? So the one thing to think about here with interest rates, number one, is that low interest rate environment spurs increased risk taking, and it does create the chance for asset bubbles to form. Clearly, we don't want to see a repeat of what occurred in the equity market in the late 1990s. That was obviously not a good scenario. I don't think we're anywhere near that scenario today at this point. At least from what I can tell, we don't have the euphoria. You don't have an equity market that's trading on the S&P 500, north of 25 times earnings. So, from that standpoint, I don't think we're there. But one thing that is worth thinking about: low interest rates does create risk taking. The lower their interest rates go, the more risk taking you're going to see. And that, of course, creates the chance for bubbles to form. Also, I think it's worth noting that, hey, look, if interest rates were to get too low, perhaps it would be a really negative, it could be a really negative sign for what's really happening in the world. And it could eventually be a negative for equity markets, because people will look at the yield curve, or they'll look at rates and say, gee, rates are at, let's just say theoretically, 10-year rate fell to 50 basis points. You could say, well, the reason why, equities why should equities perform well in perhaps in an interest rate environment at 50 basis points if the GDP is contracting, right? You're not going to see that then. So I think the low interest rate environment is a positive for equities overall, as long as we have some growth in the economy and things are doing well. Also, I think that it's worth noting and paying attention to the risk for asset bubbles. And I think it's also worth noting and paying attention for what those low rates may be signaling. If, Germany hasn't had the greatest equity market over the past year, with negative interest rates, negative 60 basis points now on its 10-year, because, their economy really is doing poorly. So I think it's worth noting. And for example, Japan still hasn't gotten back to where it was in the 1980s on the Nikkei, even though it has interest rates that are negative, because again, the economy is not doing well. So I think you need to really kind of take interest rates and think about it, but you also need to think about what's causing those low interest rates. And then the next question here from Andreas: do you think that China has enough domestic demand to ensure that their economy continues to grow at a satisfactory pace in the range of 5 to 6% without growth in exports? So I don't, there's a long answer and a short answer. The short answer is no, I don't. I don't think that they have satisfactory growth. I think that they've benefited substantially from being able to export to our economy, to be able to take advantage of our market. And I think that without the U.S. economy, I think that their economy would struggle mightily. The U.S. economy is clearly the strongest in the world. It has the biggest in terms of wealth. It has a very wealthy consumer base. So therefore, the dollar is also relatively strong to the Chinese yuan. That allows for cheap imports, and that makes the Chinese products very competitive. I think all of a sudden now with the tariffs, you can see that Chinese products perhaps aren't as competitive, and that's having an effect because companies are moving supply chains out. China can't really, I believe, afford to start selling the same level of products within China simply because the consumer there doesn't generate the same amount of income on an annualized basis as they do here in the U.S. Plus, they lose that import effect of having a cheaper product because they're within the country. So I think without the U.S., I think that China would really struggle, and I don't think it would be able to grow at the current pace it grows. I don't even know for sure that the current rate of growth is an accurate reflection of their economy, to be truthful. I always have questioned numbers that have come out of China just because I think it's a very opaque market in terms of what you can see. And then I guess the last question here is what services advice does Mott Capital provide for the IB customers? Like Cynthia mentioned before, the services I offer are through the Interactive Broker Interactive Advisor platform. I run the same exact model. I run that Cynthia mentioned, the Mott Capital long-term thematic growth portfolio. And basically, again, what I do is I look at the world and I see the events and things that are taking place around me. I think about the global macro landscape, and I try to pick stocks that I think are going to do well over a very long period of time, a 3 to 5 year period. And that's basically what I do. I offer this long-term thematic growth approach to investing that I think is kind of lost today in a world of high-frequency trading and short-term trading. This is basically a buy and hold strategy with the attempt and the idea of trying to beat the S&P 500 over a long-term period of time. And that's what I offer right now for IB customers. And of course, you can look at the website and get all the information from there as well. And I think that's going to be all the questions we have for today, it looks like.
Okay, well, Michael, thank you very much for your time in sharing your expertise with us. We really do appreciate it. And I want to thank everyone who's attended here today as well for taking some time out of your day. So with that, we are going to conclude today's session. You can all exit using the X in the upper right-hand corner of your screen. Thanks, everyone. Watch your inbox for follow-ups coming out later this afternoon. And have a great rest of your day, everybody. Thank you.